More on the EU Apple tax ruling. We're now joined in our Beijing studio by Mr. Tao Jingzhou, managing partner of Dechert LLP China offices and core member of the International Chamber of Commerce. In New York, we have Mr. Max Wolff, professor of economics from the New School University. In Brussels, we have Daniel Gros, director of the Center for European Policy Studies. Welcome, gentlemen, to our program. Let me start with our Brussels guest there. So normally tax evasion is pretty cut and dry. A country has rules on taxes, it has its own regulations, and when a company breaks it, it fine it and bring it back the unpaid taxes. But this time, theoretically, technically, both Apple and Ireland and the US government thinks that Apple has been in compliance with Ireland's tax rules, but why does EU think it has broken tax rules?
Yes, this is a bit complicated because what the Commission said was not that Apple had broken any rules, but that Ireland had broken EU rules by offering to Apple a deal which is more favorable than it deals with other companies. And that's the key point of the matter. Under European law, the government is quite free to set its own tax rates, but it is in principle not allowed to offer any special deals to enterprises because that would constitute a sort of favor or state aid, which is illegal under EU rules because it would falsify the level playing field. So the key is not what Apple has done, but what the government of Ireland has done in its dealing with this company.
So, Mr. Tao, that means a company has to follow both local or an individual state's tax rules as well as EU rules. Is that correct?
Yeah, right. You know, European Union is a special animal. You have a member state that have the set of rules and the laws, and you have a European Union's regulation as well. So, as Mr. Gros just mentioned, state aid is prohibited in the European Union according to the EU regulations. But in this case, why Ireland government has any incentive to give a special treatment to a foreign company versus the local company? I think that is a question mark we have to ask the European Union. So that's something I think is kind of unusual. Normally, state aid were there to support their local company, not to support an American company in their country.
But tax avoidance is really a common practice and is widely exists all over the world. So why can't transfer pricing be considered as legal tax avoidance in this case?
I think transfer pricing is not legal, but company can use tax treaties available throughout the world to have a different structures in different parts of the world so that they can pay less tax. This is legal. It's not a tax avoidance, it's a tax planning. They can plan this according to the tax treaties available.
Let me turn to our New York guest there. Mr. Wolff, can you weigh in on this? Is this legal tax avoidance or tax planning, or what do you think?
Yeah, so I think we might have a little bit of a potato here. I think Apple was pretty careful, and they unambiguously did not violate the law as it's presently written. Ireland may have, and I think we're missing some of the key features here. Ireland is a haven for transnational corporations who are there in part, only in part, but in no small part, for the lenient regulatory and tax environment. It's the cornerstone of their economy. Therefore, potentially subsidizing, but giving an attractive relative tax rate to transnational corporations is a huge part of the economy. And what we see here is the European Union is also being asked to do two things: hold together that union and subsidize countries, including Ireland. And if you're subsidizing countries that are moving tax revenues out of other member states and even out of their own member state to the benefit of a transnational corporation, then you, the European Union, are inadvertently subsidizing the non-collection of taxes by a member state, which is a bit of an issue, I think. But I don't think Apple did anything wrong here. And I think the other issue here is how much is the EU willing and able to regulate member states, particularly in this moment now where international free trade momentum has been hurt and where there are some more question marks around membership in the European Union in the immediate aftermath of Brexit.
Let's talk about the aftermath of that. Like you said, possible exit from the European Union later in this program. I want to talk to our Brussels guest there. So the reason why Ireland is refusing to accept this ruling is pretty obvious because of a large amount of profit that is generated by these multinationals. So let me quote Ireland's finance minister's words. He said Ireland will defend the integrity of its tax system. So my question is, does the EU has the right to lay its hand on individual countries' tax regulations?
Yes, the EU has, if they can show that the countries have used their tax regulation to achieve something else, namely to favor certain companies, basically to give state aid. But you should also keep in mind that in Ireland there's a big division between different parties, because if Ireland were to collect the 13 billion, that would be a huge boost to the public finance situation. It would be equivalent to hundreds of billions of euros for Germany, for example. And
that
therefore,
is
a large
big
part
amount
of the Irish.
Yes, that is a big amount of money for Ireland, but maybe just in the short term. I noticed our studio guest, Mr. Tao here, you shook your head.
Yeah, indeed, it's a lot of money, but the country must think in the middle range and the long run. If they really levy this tax on Apple, they will scale out all the other companies, and you have a big employment issue, and for the future income of the country. So that's why they have to defend, Apple, so that they keep their promise to Apple, and they keep the confidence of all other companies using Ireland as a platform for their European operations.
Mr. Gros, your defense.
That's actually not quite correct, because as we earlier heard, the justification from the European Commission was that the legal entity which was supposed to have paid these taxes had zero employment. There was some employment in Ireland for local Irish concerns. Therefore, to say that if multinational companies can no longer use Ireland to basically keep their profits tax-free, that this would generate job losses in Ireland is not quite true. Perhaps a few tax lawyers would have less to do, but otherwise I think the Irish economy might be quite unaffected. And that's the point the opposition in Ireland is making.
I would like to turn to our New York guest there. Mr. Wolff, would Ireland's economy be unaffected by this kind of case? Because the U.S. has threatened, if this case goes along, the U.S. Treasury and lawmakers have been criticizing the EU approach of using the competition law to challenge tax ruling. They say it is targeting U.S. companies, so it might affect U.S. investment in Europe. Is that true?
Yeah, so I doubt that macro structural investment decisions will be shifted by American transnationals on this alone. I do think that Ireland is dependent on being a favored location for transnational corporations, so indirectly this could hurt. On the other hand, we need to separate out a few different things here. One is the United States and the European Union are in a difficult series of trade negotiations, and relations are strained right now, right? So that's part of the backdrop here. Nothing to do with this case, but just in the wind. The other issue, which is major, is that the Irish are dependent on transnational corporations and being corporate friendly. If they undermine that, it would have a meaningful negative effect on their economy. But three, what happened here is not that Apple took advantage of the 12%, the much lower tax rate. It's that they paid between 0.005 and 1% taxes. So I think Apple could normalize its tax rate without really running into a problem in terms of the general tax friendliness that Ireland offers. So I think there's a few different things here. They're all related. It's hard to sort of pick them apart, but I'm not sure they're all one issue.
I would like to bring in context there for our audience there. According to U.S. law, whenever its citizens or corporation are being subjected to discriminatory system under the laws of any foreign country, the president could double the rates of that country's investment or corporation as a response. So Obama is reportedly threatening to take revenge as a result. So are we seeing a possible tax war between EU and the US, Mr. Gros?
No, I think that's very far-fetched. But there is an other problem which hasn't been mentioned so far. Again, it's technical, but it's very important. You see, under US tax law, corporations pay zero tax on their foreign profits as long as they keep their profits abroad. And of course, that is a very nice incentive for American multinationals to say, we make our profits in Europe and we keep them there. And then we channel them through Ireland, and there the profit rate, the tax rate is zero. So basically, we haven't paid any tax. And the US tax authority thinks, they haven't paid any tax in Europe, great. Whenever they repatriate the stuff, we get our full tax take. And now they see maybe the Europeans come in first and take a little bit off that. And I think that's why the US is reacting so strongly. But there's no possibility that there will be a tax war between the EU and the US.
Another response from US is that some are calling the US should review its own tax system, because a lot of US companies are making a lot of profit overseas and avoid taxes within the US sovereignty. So, Mr. Wolff, what's your response to this concern?
Yeah, so I mean, that concern is unambiguously true, and some of the odd features of U.S. tax law have made this more of a problem. I think also we should keep in mind that the U.S. is a net tax recipient. So if I'm a transnational corporation and I pay 12% to Germany, and I only have to pay the remainder of the 35% here, the 23%. So the U.S. and EU do sometimes compete for tax revenue. But I do think that U.S. corporations are also the most aggressive users of these tax shelters in Europe. And I think we're at a low moment right now for international cooperation and a high moment for nationalism. And I would remind people, too, that we're in the middle of a pretty nasty and rancorous presidential election season here, in which everyone's patriotism is kind of called into effect. And so bluster and threat get you votes in the polls in November, but they don't always or usually become policy after that.
Yeah, more tax or less tax is always a debate between the Republicans and the Democrats. Mr. Tao.
Yeah, I think because in the world you have a different tax rate, this gives incentive for company to pick this country versus another country. So it's a tax sovereignty of different countries. And the European Union is not supposed to have a power to regulate this kind of issue unless they put into state aid kind of umbrella. So now whether you say whether US and the EU will have a tax war, I don't think so, but certainly this is not good for this transatlantic partnership negotiation.
Yeah, the market's response is as calm as yours, because Apple shares fell just 82 cents. That's less than 0.8%, and it fell to a price of $106. So the market is pretty calm reacting to this. Mr. Wolff, does that mean that Apple will not pay the fine of $14 billion US?
Yeah, so they're definitely going to appeal it. I think that if they do pay it, it'll be way into the future. Probably more meaningfully, we did get some initial announcements or indications this morning in the U.S. that it's possible that Apple will repatriate quite a bit of money next year and pay taxes on that, which is a 35% rate. So I do think that Apple understands that they have about 12% of all the money being held overseas to avoid U.S. taxation is Apple, over $200 billion. So they're going to be under pressure anyway, and they were, to do something about the taxes. And the truth for Apple is it's such a successful corporation that this debate, our coverage among the other coverages of the story, is more dangerous for them than the 12 to $14 billion. So I think ultimately they will pay something. I mean, keep in mind, this is still a company that does $200 billion in sales and $40 billion in profit in a year.
That may be nothing for them. And Apple and other multinational firms have been accused of dodging U.S. corporate taxes by going abroad. Now, let's take a look at this. A study says the 500 largest U.S. companies hold more than $2 trillion in accumulated profits offshore to avoid U.S. taxes. Apple was holding over $180 billion offshore, more than any other U.S. company and would owe almost $60 billion in U.S. taxes if it tried to bring the money back there. So the study calls on the U.S. Congress to take strong action to prevent corporations from using offshore tax havens. So is that suggestion practical, Mr. Wolff?
Yeah, so we've seen it before. Usually what we do is a short-term holiday. Obviously, at long term, we might want to amend some of our corporate laws. We should keep in mind, though, in this conversation that we do hear a lot about America's 35% headline corporate tax rate, and it is quite high, but the effective tax rate, the average tax rate paid by a major American corporation is about 16%. It's about half of that headline rate. And so Apple never pays 35% on any of its other earnings. There isn't that much reason to think that their legion of creative accountants and tax specialists and lawyers wouldn't be able to reduce the bill a bit, nor would they ever repatriate all the money or have need to at once. But that being said, they probably are going to have to store a little bit less money offshore and pay a little bit more taxes going forward. And probably so are other major tech companies. So the good news for them is their competitors like Amazon and Google probably won't be in that different a circumstance.
So you think if the European Commission's ruling prevails, multinational companies like Facebook and Starbucks are expected to start paying a little bit more in the future, Mr. Gros?
I think that is the outcome that's most likely. In the end, it's unlikely that the court in Europe will say, yes, Commission, you are fully right, or no, Irish government, you are fully right. There will be some compromise, some exchange at the margin. And then I think, as our New Yorker has said, companies, big, large companies will want to avoid this kind of negative publicity. So they will come to some agreement that they pay perhaps a little bit more in Europe, repatriate a little bit to the United States, just to calm things down. That is the most likely outcome.
Mr. Tao.
Yeah. Sometimes you say, it's not reasonable, the amount is outrageous, but it's legal because the U.S. can modify their tax law so that no repatriated profit will be taxable. So Congress can pass this kind of law. So every country needs more tax. But now with 40.5 billion US dollars, I think that's the maximum that the EU can ask Ireland to collect from Apple. This is according to tax law. Normally, you can retroactively for 10 years for the unpaid tax. But is that the objective pursued by state aid regulations to retroactively for 10 years, or maybe 2 years will be sufficient? So all this are kind of a debate in the future, and also in this case, if they go to court of first instance, then the European court, it will take maybe 2 years, 5 years, or even more. So that's why there are no immediate reaction from the stock market.
But they are in a process of negotiating TTIP, free trade agreement. So if this case really turned out to be ugly, will that affect the two sides' relationship in terms of negotiating the agreement?
I see, yeah, this transatlantic agreement is still at a very early stage. Now with the presidential election in the U.S., people become very pessimistic. Also, you got German minister and the French economic minister all said this negotiation is basically dead. So that's why I'm not optimistic.
You're not optimistic. Let's ask our New York guest there. Mr. Wolff, are you optimistic about this agreement? Once there is any kind of agreement settled in the future, will EU lower its tax for the U.S. multinationals?
I think one of the things that the recent elections in Europe and the U.S., particularly the U.S., have revealed is there's a loss of free trade, favorable opinion in the public here. So I think before the elections, very unlikely. After elections, it will be difficult. The United States and the European Union ultimately will reach these deals because they have to for their future economic survival, but I think it will take longer and be less successful than it should be.